A new AM Best report looks at the South Korean non-life market segment. Here to discuss that report in detail is Chanyoung Lee, Senior Financial Analyst, AM Best Asia Pacific. Chanyoung, the report says that even before the COVID-19 outbreak, the non-life market had already experienced a tough year in 2019. What trends were negatively impacting the market?
Hi, John. So overall industry net income dropped by 40% last year, mainly because of the increasing claims in long-term insurance line and auto insurance line, which are the two major business lines in South Korea's non-life sector. So for auto insurance, which account for about 20% of total direct premiums, there were multiple factors that drove the loss costs up in the past, in the recent years, including a hike in repair costs and rise in minimum wage and growing claims from Oriental medical treatment. So the impact of these factors on loss ratio was even more severe because it started to happen in 2018, which was not long after the industry-wide premium rates cut in 2017. So for the long-term insurance line, which is the largest business lines in South Korea's non-life sector, the main driver for the increased loss ratio was the surge of claims in the medical indemnity coverage, which accounts for about 1/3 of the total risk premiums within the long-term insurance line. The medical indemnity coverage is one of the basic coverages sold by the non-life insurers as a supplement to the national health insurance. The increasing claims trend in medical indemnity is attributed to changing medical behaviors of policyholders after the government introduced a revised scheme of national health insurance in 2018, which is called Moon Care. The key revision in the scheme back then was to expand the coverage by the national health insurance in order to reduce the medical expense burdens of the households. So initial expectation was that the new scheme will contribute to improve the loss ratio of private insurers, as people now will have to pay less for the same treatment, so they don't have to claim it to the private insurers. But while this expectation was correct, there was something unexpected happening in the market at the same time, which the market is calling a ballooning effect. So non-life insurers are now seeing more claims coming in for the medical treatments that are not covered by the national health insurance. It seems that people are now more willing to pay or try more advanced or more expensive medical treatments now that they have to pay less for the treatment that they used to enjoy. And also insurance industry is arguing that hospitals and doctors are encouraging their patients to try these additional treatments. So these are the two major drivers that have put the non-lifers underwriting profitability under pressure in 2019. And additionally, we have also seen expense ratio continually rising in the past years because of the heated competition in the market.
Chanyoung, you mentioned Moon Care. How has the market responded to the so-called Moon Care, the country's revised national health insurance scheme?
Yes. So medical indemnity cover, given its nature as a supplement to the national health insurance, the regulator controls price adjustment in both direct and indirect ways, and insurers are only allowed to adjust the rates once every year. And as a note, there was no rate adjustment across the whole industry in 2018 when the Moon Care was first adopted. So after the industry started to see a surge of medical claims coming in, annual rate adjustments for medical indemnity coverage have been taking place in 2019 and more recently in 2020. Although these were far from sufficient to reflect the increasing loss ratios at the range as the range was set by the regulator. So in addition to the rate adjustment, insurers are also trying very hard to mitigate this issue, such as strengthening their underwriting and claims processes, encouraging policyholders of loss-making old medical indemnity cover to convert into more profitable policies and whatnot. And government is now also trying to support the industry in tackling this issue by more closely monitoring and regulating overtreatment by hospitals and doctors.
Now, as we fast forward to today, how are non-life insurers' portfolios holding up against the pandemic fallout?
So in South Korea, we expect the impact of COVID-19 on non-life insurers' underwriting side to be minimal. As for top line, new business sales have been and will be inevitably disrupted for a while, especially in the face-to-face sales channels. And we didn't see much decline in new businesses in the first quarter results this year, but we expect to see the impact coming in for the second quarter. But the impact on overall top line or premium income will be not material because of the large recurring premium base of the long-term insurance line. In terms of claims, first of all, claims directly related to COVID-19 will be highly limited as the government will bear all the diagnosis and treatment costs. And also in general P&C lines, claims related to pandemic or business interruption are expected to be limited based on the policy terms and conditions generally used in the market. On the other hand, we note that COVID-19 will temporarily have some positive impact on the industry's loss ratios, both in long-term insurance and auto insurance line. And in recent months, we noted that reduced mobility and less hospital visits by the policyholders led to decrease in claims in these lines. But we expect this positive impact will remain only temporarily as the country is now partially easing its social distancing measures starting from May.
So Chanyoung, what's the major driver for AM Best to change the market outlook from stable to negative?
So there are mainly three drivers for the change of the outlook. First is continued underwriting pressure, especially in the long-term insurance line. As mentioned earlier, we expect the impact of COVID-19 on the underwriting side will not be material. And even after considering the temporarily positive impact of COVID-19 situation on loss ratios, we expect that the overall profitability will not recover in the near term back to the previous level in 2017 or early 2018 because of the uncertainties around the long-term medical indemnity cover. Underwriting deterioration in the long-term line last year, especially in the second half, was more severe than we initially anticipated. And the first quarter result this year is also not very promising either. So we don't expect it to bounce back anytime soon without more fundamental changes in the medical indemnity products, such as the change in coverage structure or sufficient rate hike or a change in medical behaviors of the policyholders. So, and then the next two drivers are related to investments. And investment is the main source of profits for Korea's non-life insurers. And the current capital market situation is placing pressure on the investment side, largely in two ways. First is falling investment yield and fixed income assets, which account for majority of the investment assets of the industry. And the second is recently increasing asset risks. Talking about the first aspect, Korea has already experienced a downward trend of market interest rates for the past decade. But soon after the COVID outbreak in the country in mid-March, Bank of Korea cut the base rate sharply by 50 basis points, and recently again by additional 25 basis points to support its economy. So the base rate declined from 1.25% as of year-end 2019 now to 0.5%, which is the lowest level of Korea's history. So we already start to see long-term bond rates decreasing, and this will certainly add pressure on the insurer's investment yields from their large volume of fixed income assets, making it even challenging for the companies to secure their current level of investment spread, which have been already narrowing for the past years. Last but not least, we note that asset risks are increasing, obviously, and insurers are already facing heightened asset risks through their investment exposures to specific sectors that have been directly impacted by the COVID-19 environment. And these assets may include loaned or bond investments in sectors such as aviation, tourism, or energy, etc. And although this portion, the proportion of these assets to the total investments may not be material, but we believe that the potential impacts of credit defaults of any of these assets could be material, especially for the smaller insurance companies. And given that the pandemic situation is far from end globally, as you are well aware, its impact on real economy is expected to be inevitable. And we believe that this is likely to result in greater credit risks from a broader range of assets, such as real estate or retail or corporate loans.
And what does AM Best expect in the next 12 months or so?
So overall bottom line will continue to be under pressure in the coming 12 months, both in underwriting and investment sides. As mentioned earlier, pressure in the long-term insurance line is expected to remain, specifically in the medical indemnity product. And loss ratio may temporarily improve because of the reduced claim from the reduced hospital visits. But we expect this impact will only last temporarily, as I mentioned earlier. And so this positive impact will not be sufficient enough to mitigate the existing pressure on the long-term insurance line. An offsetting factor in the underwriting side is in auto insurance. We have seen several rounds of rate hike since early 2019 across the industry, so profitability is expected to gradually bounce back this year and the year after. So assuming that all other cost factors remain similar, we expect that the auto insurance will improve gradually going forward. And as for the market competition, we expect it to be somewhat subdued under the current pandemic situation. Also because companies are now more focusing on securing their profitability after they were severely hit by their bottom line cut last year. Last, on investment side, we expect investment yield to decline gradually, and given the current and prospectively volatile capital market, obviously, insurers will be put in a very difficult position to choose between safe assets bearing ultra low yields and assets with better yields but very higher risk exposures. So we expect to see higher volatility in profits as investment profits provide thinner buffer to the overall bottom line going forward.
Thanks, Chanyoung.
Thank you, John.
That was Chanyoung Lee, Senior Financial Analyst in AM Best Asia Pacific. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.